vetting out the team and the deal, and I'm participating by putting in some of my capital. And then I'm sitting back for 3 to 7 years and just collecting, the rent checks and just sharing in the profits on these deals.
Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on the race to financial freedom through real estate investing and sound financial practices. My name is Mike Moe, one of the hosts of the show, joined today in the usual fashion with Mr. Fierro. What's up, sir?
I'm just here hanging out, trying to think about a way to discuss real estate. And then all of a sudden you called and said, let's do a podcast.
So, yeah, like you needed another excuse to chat real estate.
No, I did not. I've just been itching for somebody to ask me a question, Mike. And
heck yeah, I'm good at that. Let's do it.
Let's do it. All right. You wanna get started with the warm up?
Yeah, man. Let's do it. What do you got for me today?
Okay, this is an exciting episode we got coming up. It's a great interview. So I'm going to do something that we heard about in the interview that you're about to hear, and that's a PPM. I like initials and letters. A PPM is a private placement memoranda, which is a legal document provided to prospective investors when selling stock or another security in a business. It is sometimes referred to as an offering memorandum or offering document.
Yeah, man. It's so we're talking about, the basics of syndication, right? And talking to Travis about the limited partner side. So if you are investing in a syndication as a limited partner, you will likely be presented most guaranteed be presented one of these, basically a massive document that a very highly paid lawyer likely put together that'll outline all the details of the deal and how you might potentially lose money. And it's scary, but one of those necessities of offering an investment to potential investors is to make sure that they are fully aware of all the potential pitfalls and how the deal is going to be laid out. So yeah, a bunch of legalese, bunch of terms of the deal and the ins and outs of it. So.
Oh yeah, and this is one of those things that the PPM is something that's going to tell you exactly how you make money. Like you just said, you can't do anything in real estate with passive investing without getting that PPM.
Yeah, for sure, man. And it's gonna have all the details in there on how you can cover your own butt. So you make sure that it's one of those things where you don't want to read line for line, but yeah, it won't hurt you. You want to cover your bases, right? So.
And if you don't want to read it line for line, at least have an attorney or somebody read it line for line, and then they can do the cliff notes on it or whatever. So
yeah,
give you the
that's a good point, man. You should have an attorney in your court kind of doing some of this homework for you, because even if you read it, let's be honest with you, even if you read it, you might not understand all of what it means, in the terminology that is put forth in those documents. So it would definitely be a good idea to have your own attorney, read these documents and make sure you're getting yourself into a good deal, or not a good deal, but it's something where you're not getting taken advantage of. So
absolutely.
You're not going to proofread your deal for you, but we'll help you cover your back.
Yeah. So I think I'm pumped for this interview. Let's jump into it.
Yeah, dude. This is Mr. Travis Watts, who started active in the business, but is now a full-time passive investor, man. So like I said, we're kind of on this investor basics of syndications, and this is going right into that passive side. So I'm excited to hear what he's got to say.
Yep. Let's do it.
Cool. All right, Travis Watts, welcome to the Real Estate Marathon Podcast, man. How you doing?
Hey, Mike and Larry. Thanks for having me. Doing well.
Good. We're super excited, man. We've been on kind of this investor basics series with our listeners, and have been diving into syndications, and we're really excited to learn a little bit more about the passive investor and the LP side of things from all your experience. So really excited to dive into this, man. So
yeah, very
cool.
Excited.
Yeah, me too.
Thanks
Before we jump in right to grilling you with all the questions, would you mind just giving the listeners a little bit of background, who you are, what you're doing, and kind of how you ended up where you are?
Sure. Yeah. So I consider myself to be a full-time passive investor. I didn't start that way. I started out on the active side of real estate. So I did a lot of fix and flips, vacation rentals, owner occupied homes, house hacking, everything you can think of except for wholesaling, I think. I've probably done it. I just, long story short, I burned myself out. That's what happened. I was trying to scale that portfolio on top of working a W-2 job that was 14 hours per day, 98-hour work weeks, away from home. And, that can only last so long. That's not very sustainable. So I thought, what do I want to give up here? And it kind of turned out both. I didn't want to do active real estate, and I really didn't want that career choice as well. So in 2015, I just kind of had a big pivot moment in my life, went a completely different direction, found out how to be a hands-off investor, and went that route. Left the oil field to pursue things that I actually enjoyed and cared about.
Awesome. So that now is full-time passive investor, huh?
Yeah. So and to the point of, to me, financial freedom and financial independence is always what I was seeking from way back when, even in high school. I kind of ultimately had that as a goal and a dream one day. Didn't know how I was going to get there. And so what happened was when I left the oil field, I just started pursuing ventures that were, highly impactful to me, that I could learn from, that I could share from. And so I worked for a brokerage firm for a little while, realized I didn't like it, so I quit, and then started working for a syndication group, a small startup group, and that was fun, learned a ton. Now I work with Ashcroft Capital in investor relations. So they're a national known syndication firm. They do a lot of deals in Texas and Florida. I've been investing with them about 4 years. So the beauty with that is that I get to network a ton. Leading up to COVID and lockdown and all this crazy stuff, I was going around nationwide to conferences and seminars and just mingling with other passive investors. Picking people's brains as much as they were picking mine, and it's a relationship business, as you guys know, and that's really what I want to be doing right now. So I have the freedom to do that.
Awesome.
Which is great.
Very cool.
Now, what for some of our newbie listeners and people that are wanting to get into real estate, what exactly does passive investing mean to you?
Yeah, that's a good question, because the term gets thrown around, in my opinion, a lot in the wrong context. So I used to think that having single family homes and managing my own tenants was passive income, because I was told that through programs, books, what have you. But it may be somewhat passive for a while, or say property number 1 through 5, for example, but there's going to come a time that starts getting more and more hands-on. It starts getting more and more active. Even with property managers, there's decisions you have to make. There's things that happen. Do you want to patch your roof or replace it? What do you want to do about the HVAC units getting old? I mean, and collecting receipts and building your own team and working with your own CPA and setting up your own entities, and all this stuff is time commitment. And so to me, a passive investor means participating in real estate without having to manage tenants or deal with any home repairs or toilets or evictions or any of the stuff that comes, with real estate, right? It's part of the nature of it. So I invest a lot in apartments through syndications or private placements, where I'm leveraging a team and their expertise and their background, their track record, to go execute these deals for me, and to hire the right property management companies to deal with all of this, and the right attorneys to set up the right docs, and the right CPAs to do the right tax forms. And so really all I'm doing at the end of the day is vetting out the team and the deal, and I'm participating by putting in some of my capital. And then I'm sitting back for 3 to 7 years and just collecting, the rent checks and just sharing in the profits on these deals.
Nice. That's a good point, man. I think a lot of people get the mailbox money mentality when they're, buying houses or buying small deals themselves. And I think it is truly passive. But to your point, if you're running these things like a business, like you should, if you're in the active side, there's a little bit of legwork and a little bit of running around just in the business side of things. So yeah, what you're doing is definitely more on the truly passive side, right? You're just sitting back, and obviously you're vetting the teams, but it's truly more that passive.
Yeah,
side.
you can think of it a little bit kind of like like buying a stock or a REIT, a real estate investment trust, or something like that. I mean, obviously that's passive, right? It doesn't take any hands-on effort. The only difference is in the types of deals I'm investing in, they're private placements, meaning that they're private offerings, so they're not publicly traded. So I'm not dealing with the stock market in general. It's an illiquid investment that doesn't have the same volatility, things like that. But yeah, it's that form of passive, in my opinion.
Very cool. How does somebody get started investing passively like that?
Yeah, I think that it's more like a concept than it is any specific, opportunity or deal or sector. Obviously, real estate, that's a very broad, vague topic, right? Real estate can mean a lot of different things. To me, realistically, let's just cut it down to the basics, right? If you want to be a passive investor and you've got $10, you could buy a publicly traded REIT for $10 that pays you a monthly distribution of passive income. And there you go, you're a passive investor, right? So, you can start from that level all the way up to, buying your own apartment complexes and putting $5 million down and going from there. So a lot of different approaches. The way I approached it was I focused from 2009 to 2015, I focused heavy on building up a nest egg, building up equity, saving a ton of money. I was just raised by two extreme frugal parents. And so, I had a crazy savings rate for years and years and years. And I parked it all into real estate, until I could build enough capital to put it to work passively to where I could actually leave my job is what happened in 2015.
So I think you kind of led into our next question. With passive investing, can an investor actually achieve financial freedom, and can they make as much money as they want to and create that generational wealth, that kind of investing?
Gotcha. Yeah. So the important thing to think about is a lot of people ask me, if you could go all the way back to 2009 when you got started, would you have been a passive investor? My answer to that is no, because with the amount of capital I had to work with, if I were to put that to work for 8 or 9 or 10% annually, let's say, it wouldn't have made that big of a difference in my life. I would have had just such a small amount that I would have had to keep working a full-time job. I couldn't have really covered much at all with that. So I would have, in some respects, kept the same path that I took, which was being frugal, saving money, yada, yada. Obviously, I could have done things differently to get there faster and more efficiently. I went about it the hard way, if you will. I think, why didn't I just start a business and sell it for like $5 million? That would have been easier.
There you go. Nice.
Potentially. But no, I just, I kind of followed the FIRE movement, financial independence, retire early, which is a lot of saving, living below your means, making as much income as you can make, but living on a lot less. And I'm parking that gap into real estate. That's what I think.
Yeah, awesome, man. That's we're big fans of the FIRE movement and talk a lot about the financial independence side of things on the show quite a bit. So great to hear you're on the same line of thinking. So question for you on how, are there different levels of passive investing? So I hear a lot of people who want to start passively on the limited side so they can learn and, eventually go to the general partner side. So are there ways to do it that you're more involved but still on the passive side?
That's a good question. So, initially, as I started investing in the sector, I wanted to learn it from the inside out. I didn't just want to be an outsider putting money in a deal and then trying to read between the lines on the monthly updates or whatever. So I actually went to work for a very low paid position for, a startup syndicator. I knew I had things I could offer. I could do a multitude of I have skill sets that can carry over, right? But that's what I did to kind of learn it, is I was adding value, kind of like an internship almost, if you will. Granted, I had the ability to do that because I already had some cash flow to kind of back me up and support my lifestyle expenses. So consider that as well. Yeah, man, there's different ways. A lot of people do the LP, as you said, to one day become a GP. That's fine. You can hire mentors, coaches. There's plenty of programs out there. There's lots of books you can read. Different strokes for different folks, right? But at the end of the day, the things that made the biggest difference to me were finding actual mentors, actual people doing what I wanted to do, and then picking their brain, adding value where I could.
Nice. Yeah. I just want to highlight again that FIRE side of the financial independence. You're able to take that opportunity because you had set yourself previously with, some buffer between, your active W-2 and with some passive income. So that's awesome.
Yeah, I would say, so I'm an extremist in that I'm a, full-time passive, right? Most people aren't, and totally fine, right? So most people who are doing this type of investing are just highly paid individuals that don't want to take their eye off the ball of whatever it is they're doing. So doctor, dentist, lawyer, attorney, professional athlete, you name it, but they're folks that are making a good income. They don't want to go be a weekend warrior trying to go flip houses on the weekend and take their eye off the ball. So that's something to self-reflect on too. And a lot of folks that are active in the space, they are GPs or they are flipping homes, this can be a great strategy to just diversify and say, yeah, I do that primarily, but I also throw some capital over here so I can get in some markets that I don't personally specialize in, or scale my passive income a little broader without sacrificing my time commitment.
Yeah, nice. Awesome.
One of the questions I had for you with going back to you had said that you are passively invested for 7 to 10 years. When you finally cash out of whatever project you're in, do you take that money and turn it around and roll it over into the next project, or do you stagger your paydays, that sort of thing, just to make sure that you continue your lifestyle?
Yeah, it's a good question. I try to keep as closely as I can to the same passive income. So what I'll typically do on the back end of a deal is not do a 1031 exchange. That's kind of a different topic, but I typically won't do that. I'll take the proceeds, I'll divvy them up, usually 50-50. I'll divide them and I'll go do 2 new deals. And historically speaking, that's been trying out new sponsorship groups. Just to diversify that way. As I move forward, I'm a little hyper diversified right now. I've partnered with over 14 firms, in 30 deals. So I'm probably going to start reeling it in a bit now and saying, here's my top 4 or 5 to work with, and just doing 2, 3, 4, 5 deals with them instead of one with all these different groups.
Awesome, man. So I want to transition into a little bit of what I think is, and I'd love your opinion on, is one of the most important part of being a passive investor is vetting the sponsor, right? So obviously a lot goes into the teams and who are managing these deals and finding these deals. So how much legwork from a passive investor should they expect to do in like vetting these sponsors and really kind of just, doing their homework on them?
That's a great question. So it is a relationship business, as we pointed out earlier. It does take a fair bit of front loading. So this whole passive investor thing is totally a front loaded model. So you're going to put in some legwork, make a decision, wire funds, sign docs, hands off at that point, right, for several years. But assuming you're going to do more than one deal, it's kind of back to the active, right? Now, got to find a new group and do my due diligence on them and vet them. So it is active in a sense, but it's also optional active. So you can also just find a group that you love working with and just do a bunch of deals with them, for example. Yeah, to your question, it's all about the team. It's all about the sponsorship. What you're really betting on at the end of the day isn't so much the deal, though that's important, obviously. It's the team. It's their ability to execute the business plan and actually do what they say they're going to do. So how do you know that's going to happen? Well, you don't, but you can look at their experience, their track record, past performance. Do they specialize doing the same business plan over and over and over? Or is this like some experimental deal they've never touched before? It's self-storage and all they've ever done is multifamily. These are somewhat of red flags potentially, but, not necessarily. It just depends on, who's on their team. Do they have mentors, coaches? Are they bringing in co-GPs that do have that experience level? It's dynamic, but you want to find a team you trust, you get along with. It's a long-term relationship. You're going to be in communication with these folks for 3, 5, 7 years, maybe longer. So you definitely want to do your due diligence just like you would on anything else out there, like building a friendship. You want to get to know them a little bit before you pull the trigger, right? And commit to something, or a marriage. Maybe that's a better example.
Awesome.
Now you say you've got 14 different deals going with 14 different sponsorship teams. How do you go about finding the sponsors? I mean, did they come to you? Do you go out and actively seek them? Is there a classified ad you can take out on Craigslist? I mean, I don't know what's going on.
You probably wouldn't do that. I'd like to know what the results are.
Challenge accepted.
Yeah. Let me know. Circle back on that one. For me, I started online. So I started through like Bigger Pockets, I think it was, an online forum, just kind of trying to pick people's brains, who's been in the space a while, who's partnered with these groups, how's that been for you? And then I branched out to seeking local operators in my 60-mile radius. So that was just done through Google searches and phone calls. But then what I started doing later is going to conferences. So nationwide conferences, seminars, real estate meetup groups. I started joining networks, and it's a natural progression. But now it's like information overload. On too many deal lists, I get sent way too much stuff. So you got to find a balance in there. So I have the opposite problem. It's like, how do I stop getting getting sent these deals that don't match my criteria. And where a lot of folks were like me in 2015, where it's like, where the heck are these operators? Because there's a lot of SEC regulation in the industry, and most people are doing these 506B offerings where they can't publicly advertise their deals. So it's kind of hard to find where are all the deals, right? That you actually have to find the groups that are doing these and then build a pre-existing relationship with them. So it takes an element of networking, but it gets easier like anything else. You put a few people in your circle and they introduce you to 5 or 10, and there you go. That could be good for a while.
So I want to kind of marry up a couple of things that you responded to in the last couple of questions. You talked about red flags when vetting a sponsor group, right? And the track record. And then you also talked about, going to these events and these networking events. And it seems like, I haven't been in real estate for as long as you have. So I'd love your perspective as, how long you've been in it, that in the last handful of years, everybody's, raising capital. Everybody is, doing their first 1 or 2 syndications. So is that necessarily a red flag to that point? And are there other red flags? It seems like over the last handful of years, everybody's jumping into syndication and don't necessarily have a ton of experience doing so.
Yeah, no, that's a great question too. So the first few deals I did were with new operators or newer, right? Maybe done 1, 2, 3 deals, right? So pretty much green. I realized that and I recognized that. I was okay with it at the time. But what I learned is that what made the difference is this. They had nobody with experience to bring on the team. They had no mentor, no coach. They hadn't gone through any formalized training programs. They got this idea, we're going to start raising capital and buying real estate. And they just were winging it. And that's a red flag to me. I don't have a problem, and I still will invest with a group doing their first, second, third, fourth deal. But I make sure that there's somebody over their shoulder, that they've come out of some credible network or group, or that they have a mentor that has 20, 30 years experience that's helping them underwrite. There's something like that has to be involved. For the most part, anymore, I invest with teams that have 20, 30, 40 deals under their belt at least, or at least 5, 10, 15, 20-year track records, that kind of stuff. So everybody's different, but again, you're betting on the team's ability to execute the business plan. So however you want to look at that and feel comfortable with it.
Nice. Would you expect, as a limited side, would you expect, I guess, a bigger slice of the pie on somebody, sponsorship team who doesn't have as much of a track record?
That's a good question. One thing I look at actually is anymore, I don't try to look for the highest returns on deals because they're only projections anyhow, right? It's really the reality of the business plan. I look for that's really difficult. So whether a new team or an experienced team, a light value add plan can be a great thing. So to answer your question specifically, not really. I don't try to say, hey, you're new, so you should take less fees or give me a higher amount or whatever it may be. I don't look for that. Some groups will do that and they'll lessen their fees just to start building up their investor base. That's fine. But I just kind of look for middle of the road, reasonable win-wins on both sides.
Oh, awesome.
Now you're selling me on passive investing. You're making me a firm believer in it. So I'm actually going to be getting off the podcast here, and I'm going to go start looking for sponsors. But the question I have is, what kind of, it can't be all great. Is there some risks and pitfalls that you have to be aware of, just some dangers?
Of course there are, yeah. So with any type of investing, there's always risks. So one metric, I'll point out, we'll just start with this. One metric that I look at a lot to see how conservative a deal is I look at the break-even occupancy. So that's, say you have a 100-unit building, you usually don't invest in deals that small, but if you did, in a 70% break-even occupancy, you can afford to lose 30 tenants and pay the bills. You may not get return per se, but at least you're going to have a stabilized deal in that regard. Yeah, so debt structure, break-even occupancy, track record and experience of the team. These are all things that can have potential red flags, right, for you as far as risk is concerned. So in my experience of doing syndications, I've worked with some pretty new groups, some groups that quite frankly didn't know what they were doing, but they did buy a good asset in a good market, and we did end up being profitable. But I also recognize that has a lot to do with the market cycle as well. And so right now could be, a time that you have to do some extra due diligence, right? Whether we're going into a bad recession as an economy, don't know. Whether real estate's really going to get beat up in the next 6 to 12 months, don't know. So it's more important than ever to be doing your due diligence on a sponsor. And if you're not comfortable taking on the risk of what could happen, don't do it. Just don't do it. And just keep educating yourself, and maybe, wait till we're kind of out of the next dip in the market cycle. But the reason I continue to invest even through COVID and lockdown and all of this is trusted operators, great experience, track record, experience from 08, 09 in most cases. Properties we bought are 80s, 1990s, early 2000s. We can kind of see the historicals and how they performed in a recession. That gives me a bit of comfort. And I'm a cash flow focused investor, so I really don't care on a pro forma if it says we're going to sell for this price in 5 years, because I recognize that may or may not happen. But what I am looking at is the preferred return and the realistic cash flow this thing can produce and the break-even occupancy on it. So that's what keeps me going with it. I put a lot of time in about 4 or 5 years ago in finding an asset class that's going to perform in good economies and bad economies, because I want to be in it for the long term. I don't want this to be a cryptocurrency that does well right now and then in 20 years doesn't even exist. I don't want to have to start over later in life.
Yeah, understandable.
Can you expand on some of those maybe other metrics that you use to assess the deal? So you talked about a few of them there, but are there any other key metrics that you want to make sure that you account for when you're looking at a deal?
So the way I do it is I'm macro level research, right? We're talking about tenants and their ability to pay the rent. And so what I'm looking at are where are people relocating to, where are jobs relocating to, looking for employment diversification in a city, looking at tenant and landlord laws, looking for tax-friendly states where businesses want to conduct business. All these kinds of things are kind of macro high level. And I'm deciding on which states I want to do business in and where I want to invest in. And then from there, I'm letting the sponsorship team fill me in on the very specific submarket and city that the deal is located in and why I should be looking or considering that particular offering. You can't specialize in everything. I can't know every city and every submarket, but why Irving, Texas? I don't know. So tell me about the 3 mile radius and the 5 mile and the 7 mile and the jobs and the school systems and the neighborhoods. I leave that up to the sponsorship team. So I just do the high level. And then I know that's part of my criteria. So if someone sends me a deal, for example, and I don't know, San Francisco, California, and it's a new development deal and it's self-storage, well, I'm out, right? Like that doesn't meet my criteria. That's not what I'm interested in. So defining your own criteria can help a lot too in this process as you're getting started.
Now, for sponsors, when you vet a sponsor on a particular deal, do you prefer that the sponsors are incentivized based on the deal performance so they actually have a little bit of incentive to get you more money for your investment?
Good question. So again, kind of like I alluded to earlier, I'm trying to find a win-win in all respects. I want the sponsorship team to be fairly compensated for what they're doing. I want to be fairly compensated for taking the risk. And then I want the tenants to actually have a better community, a better environment that's safer to live in. That's kind of what we're looking for, not just to slap some paint on a property and then say, all right, it's worth 10% more now. That really doesn't help anybody. So there's usually 3 types of fees in general that a sponsor's going to take, right? There's kind of an acquisition fee, which is reimbursing the cost of finding the property, putting it under contract, doing all the walkthroughs and the surveys and putting the legal docs together. There's a lot of time and money involved in that process. And the ratio of deals that a lot of sponsors look at compared to what they actually, get under contract is vast, So I want to have a big range. It could be a 1%, 2%, 3% fee upfront upon closing of the purchase price. So that's usually a factor. Then they have asset management. Like we talked about earlier with single-family homes, even with a property manager, there's still a lot to manage as to the actual business plan and the performance and making sure the contractors are doing what they're supposed to be doing and the property managers are too. So there's usually a 1%, 2%, 3% fee there as an asset manager. I want them to have that. what I like to see on that fee is that the preferred returns have first been paid to the limited partners before that fee is taken. I think that's a very nice alignment of interest. And then the biggest fee should always be, in my opinion, on the back end of the project. It comes at sale or refinance. It's when, you get your big chunk of change, so to speak. So there's usually a split of the profits. It might be a 80-20, a 70-30, a 60-40, meaning let's say 70-30, meaning 70% of the profits upon sale go to the limited partners who took the risk and put up the money for the deal. 30% goes exclusively to the general partnership. I think that's fair. And, the more it sells for, the more they make. So yeah, I mean, that's all encompassing to how well the business plan was executed. And if they were able to line up qualified buyer going to close on those. So that's your typical fee structure. It's going to vary on sponsor to sponsor, but yeah, absolutely. I'm happy with everybody making a good chunk of change.
Cool. Last question I got for you, Travis. In your experience and all the research that you've done looking at passive deals, is there an asset type or class that you think for the cash flow investor from a passive side works best? Obviously it's multifamily or self-storage, or, there's obviously different variations of C, B, A class multifamily. Is there a particular type that works better for this cash flow passive investor?
Yeah, it's a good question. I primarily invest in B class properties. So 1980s, 90s, early 2000s with a value add component, and specifically that are stabilized assets. We may have 90% occupancy or higher upon takeover. And I don't like the business plans that try to run off a huge percentage of the tenants and then replace the whole tenant base, or an opportunistic deal where the current occupancy is maybe 50% because it's got big problems, and then those problems are trying to get fixed, or a new development deal where there may not be cash flow for X amount of years, things like that. So for me, I try to find deals that pay monthly distributions, ideally. They also, most of the time, if that's the case, they do monthly reporting so that you can keep a closer pulse on how the project's going. And like I said, they're stabilized and cash flowing out of the gate. So your distribution should start, within a couple months usually of closing the deal. So that's what I found to be the best is B and C class, value add multifamily. But hey, I've invested in, self-storage and ATM machines and all these different things, REITs, but that's my personal preference. That's my criteria.
Awesome. Interesting. ATM machines, huh? That's an interesting one.
Yeah, it's another monthly cash flow, so no equity upside, but interesting
stream of income
deals out there.
Nice. Well, we do appreciate you coming on to the podcast today, Travis. I just wanted to thank you again, and I wanted to see if you wanted to let the folks know where they can go to learn more about you and where they can connect with you.
Sure. Yeah, absolutely. So I spend, a big part of giving back to me, in my opinion, is giving back my time, sharing resources with people, connecting them to folks that can help in whatever they're trying to do, whether it's house hacking, whether it's, passive investing, syndication. So I've got a link to here. So it's at ashcroftcapital.com/connect with Travis. You can set up a free 15-minute Q&A call. Happy to discuss anything we've talked about on this podcast, or anything in the listener's specific situation. I also have a downloadable guide. It's called Understanding Real Estate Private Placements. It's a 20-page guide. It's got industry terminology, how to vet operators, sponsors, deals, markets. There's so much information in that guide, completely free, no strings attached. So /connect with Travis. You can get both those resources there.
Excellent.
Awesome. Very cool, man. We'll make sure to link those in the show notes as well, because like Larry said, we really appreciate you coming on and sharing your story. And obviously those are some really key resources. Exactly what we're talking about, right? How to get more involved in it, how to vet some of these sponsors. So definitely a wealth of knowledge. So really appreciate you taking the time and sharing what you know, man.
Thanks, Mike. Thank you, Larry. I appreciate it.
Travis. Take care.
All right, Larry, what an interview, man. Travis has just got a ton of knowledge on the passive side. Well, passive, active, he's got a ton of knowledge on all sides of the syndication model.
I know, man. I was sitting there the entire time he was talking. I was just like, passive investing is for me because I nobody wants to change that toilet at 2 or 3 o'clock in the morning. And that's whenever you tell somebody that you're a real estate investor, that's the first thing they go to. I don't know why. Is there a lot of toilets out there that need to be changed at 3 a.m.? I don't know. But I know I'm not doing it. And I know that if it has to be done, that somebody else can take care of it and I can still make the money on the property.
Yeah, exactly, man. And like you said, he gave a ton of information on how to do that and increase your chances of success if passive investing is your route that you want to go. So awesome interview with Travis. Wealth of knowledge of that guy. And again, if you guys needed that information on where to connect with him, that's ashcroftcapital.com/connect with Travis, where he's giving away a ton of free content. You can connect with him over there and learn more.
So our call to action today, what are we going to have the folks do to try and help them get to financial independence today?
Well, we're gonna bring it back to basics, man. So we heard Travis's story on how he was working in the oil field or the oil industry, I should say, not the oil field necessarily, but he decided that he wanted time freedom and financial freedom, and he picked real estate initially on the active side and now on the passive side as his vehicle of choice. So the call to action. We assume that a large chunk of you guys have chosen real estate as your vehicle to achieve financial independence. If you haven't, what is your vehicle? You need to make sure that you have a means to get there. Everybody wants to have, complete control over their time and this, financial freedom that we always talk about. But if you haven't picked real estate as your vehicle, it's totally cool. There's 1,000 different ways to get there, but have you picked your vehicle and have you doubled down on that and dove into that industry or that niche or whatever it is that you want to do to achieve financial freedom? If you haven't, start thinking about what that might be.
Yeah, figure that out and then start making active steps to get there. Like you said, It doesn't necessarily have to be real estate. That's just what we chose. But, figure it out and make that goal, that plan that you want to get to financial freedom because, you got to get it started as soon as you can.
Yeah, exactly, man. And then eventually you could have, complete control over your time, such as Travis and yourself have at this given moment.
There you go. Well, that's everything I've got for the folks today. That was a great interview, and we got a bunch of good interviews lined up, so stay tuned.
Heck yeah, man. All right. Thank you guys for tuning into another episode of the Real Estate Marathon Podcast. We'll see you next time.
Take care.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group or follow us on Instagram and Twitter at Real Estate Marathon Podcast.